Hope everybody can see our screen, and welcome to investing in tax liens and tax deeds with your IRA 401k. The first thing I'd like to, let me get to this, discuss is our disclosure. And let me read it here to you. The views expressed by the speakers at CAMA webinars are those of the speakers only and may not reflect those of CAMA, its members, or employees. CAMA does not guarantee the accuracy of information provided by the speakers or attendees. Professional advisors should be consulted before implementing any options presented. CAMA absolutely does not endorse or recommend any individual or organization, including the speakers. Do your due diligence. CAMA, its members and employees do not accept liability for losses and/or damages arising from errors or omissions within, reliance upon, or any use of information provided by the speakers. Individuals are strongly encouraged by CamaPlan to conduct their own due diligence before making any investment choices, and also are encouraged to bring in any of their professionals. CAMA does not act as nor offer services of an investment advisor, CPA, realtor, or attorney. If tax, legal, accounting, investment, or other similar expert assistance is required, the services of a competent professional should be sought. Now that we got this out of the way, let's go over quickly what CamaPlan does and what we're trying to do today. The IRS requires you to use a third party to open up a self-directed IRA. We're a neutral third party, and as we just discussed, we don't give any investment advice or products to sell. We specialize in the use of tax-free and tax-deferred retirement and savings plans. We basically keep the records of the transactions and report to the IRS so that you can do traditional and non-traditional assets in your IRA. We just want to be part of your core team of professionals and record keepers. So when you have a self-directed IRA, one of the things that you're allowed to invest in is tax liens and tax deeds. Other people talking about real estate, but the tax liens and tax deeds we're talking about primarily today are all tied in with real estate. You can invest in notes and private placements as well as with your IRA, and some people actually think that tax liens are in the note family, and we'll discuss that a little bit further on. I was asked by several of our clients to talk about tax liens and tax deeds because I've done a lot of those and started investing in them in the early 2000s. But I'll tell you a little bit about myself. I graduated from Cornell University in '76 in engineering. I went to Kennedy Space Center and Cape Canaveral Air Force Station in Florida. Started off launching the shuttle, doing the R&D and launching shuttles, and then went to some commercial and secret launches on the Titan program. I've developed both commercial and residential properties. I've had a mortgage broker business. I'm one of the founders and managers of CAMA Self-Directed IRA LLC, and I have investments in real estate in multiple states, and I do tax liens in multiple states, and am a third generation investor going back to my mom and dad and their moms and dads. So today's agenda, we're going to identify the difference between a tax lien or tax certificate and a tax deed. We'll discuss different ways of purchasing tax liens or tax deeds. We'll identify entities such as LLCs, trusts, etc., that can purchase tax deeds or tax lien certificates. Some people like that capability versus doing it personally. We'll evaluate the pros and cons of the different entities that can purchase tax liens and different ways you can do it. we'll examine a step-by-step approach to utilize your IRA or 401k so that these tax lien certificates and the earnings from them are tax deferred or tax free. We'll talk a little bit about our fees, and then we'll go into what to do next and any questions. I will also take questions during the presentation. Just type it in the question box, and I'll try to answer it as we go along, or I'll get to them at the end of the presentation. So tax deeds. When you get to tax deeds, you're actually getting the property, you're getting the real estate, and you're getting the liability that goes along with that real estate. And let me first say that this process will be different based on the different states in the USA that you're buying tax deeds or tax lien certificates. Some states don't even have tax liens, they go right into the tax deeds. Sale or rental property for dollars equals work. You have to usually get what they call a quiet title after you get a tax deed at a sale, and then it's a lot of people think it's more time consuming to have tax deeds or real estate. I do have real estate, so I don't mind getting tax deeds, especially if it's a good price. Now the tax liens is paper, and that's basically a loan with interest on it is how most of the states set up tax certificates. But one of the things that you have to understand is that it's limited control because people don't have to pay you monthly. It can go up to many years. As an example, I'm most familiar with Florida tax liens, and they can go up to 7 years without paying, and then you can force a sale. But you can also force a sale of the tax lien certificate in Florida after 2 years. Other cities and townships and states will allow you to force a sale sooner than that, maybe a year, or go right into the tax deed sale. It can result in a tax deed, so you may be able to buy a tax lien, force the sale, tell the sheriff or the attorney that you want to sell the property according to the state laws, and if nobody bids on the property, then you'll end up with a tax deed giving you that property in most cases. I've been doing this for a long time, and I've only got it since early 2000s, and I've only got one tax deed that I ever learned about, and I actually bought into that with another person because I wanted to see the process and understand it. I think the time it consumes from you is less than the tax deed with the real property, and you're basically making interest on the money that you pay to the government for the tax deed. I mean, for the tax lien. So that's why a lot of people feel that it's a note. One of the other things that I like about tax liens and tax deeds is they are generally in front of any mortgage. So if a bank or an individual has a mortgage on a place, the tax lien will go before it, and if it ends up in a tax deed, you will end up with the property, and the mortgage will be washed or disappear in most cases. So let's talk about how the process works. When I started at this, it was generally done in a courthouse. It was done on the courthouse steps. Then they moved to hotel rooms because it would go on for 3 or 4 days, and they would list each property in the county that was for sale. Since that time, they've gone to on-site auctions in most states and municipalities. You can go to www.bidforassets.com, but there's many other ones out there as well. Google it and you can figure it out. But that's just a different means of purchasing in the process. When we were in the courthouse, they gave us a paddle with an auction number on it, and we would bid at the auction by raising our paddle. Now you bid online using your computer in most places. There is another way to purchase them too, because a lot of times when they do the online auction, there are certain tax liens that aren't purchased. So you can go back to the county shortly after the auction and say what's left on the board. You can look at it online and then you can purchase them right there and you don't have to bid it. If you do that in Florida, most of the time you'll end up with an 18% return. Georgia has some good returns also. And then there's a secondary market too. There's people that actually buy tax liens and then resell them to other people after they hold them for there, and that's what I mean by the secondary market. So there's several ways: buying it directly at the auction house, waiting for the auction to be over and looking at buying them off the shelf. And the advantage of these two things is there's thousands usually when you're buying online, and a lot of people say do your due diligence. I just found it so time consuming that I couldn't do a lot of my due diligence on the properties. The information has gotten better, but I used to bid them without doing much due diligence at all. I don't recommend that. So if you want, at the end of the auction, go look at the ones you want, do all the due diligence you want, and then purchase it or not, because you don't have a time frame and you don't have to do it right online. I mean, literally now they do thousands of tax liens in 1 or 2 days in most municipalities. So every 2 hours you've got a bid on tax liens in one county. How do you do that? Basically, you go to the county website or to a site like Bid for Assets. You register your name, address, social security number, or your EIN, depending on whether you're a trust, an individual, or an LLC, or some other entity. They usually request a down payment. That down payment is sometimes $50 to $100. A lot of them will say you've got to put at least 10% in of what you're going to purchase. So let's say you were going to purchase $1,000 worth of liens, then you'd put in $100. If you're going to purchase 10,000, then you'd have to put in 1,000 into your account. And this is a little bit different going on there. And then your final payment, they would just take from your account as well, especially if you're on one of the online auction sites. And these requirements change annually, and the payments actually will come back from the bank account that you give them access to put money into and take money out of. So it's like an ACH, bill pay type situation that gets started here. So how do you buy them? One, I said you can buy them personally. Two, you can buy them in your IRA, 401k, or other retirement plans, including educational savings accounts and health savings accounts. Or you can set up a limited liability company, a personal property trust. Some corporations buy them, some partnerships buy them, and some investment clubs buy them to spread any of the risk. So all of these different entities can purchase and sign up, like we just talked about, to buy tax liens or tax deeds. So let's go over some of the advantages of it, right? Beneficial interest, or ownership in the entity. If you're buying it with multiple people, if you're in an LLC or a trust, you have more autonomy, control of the entity. You're minimizing or mitigating your risk. One of the things is now you have partners. You may have local knowledge in the area that you're there. You may have local proximity, time, and you get to spread the work. You also have partner expertise if you go into an entity and you pick your team members. You may put attorneys on there, appraisers, builders, developers, title companies, somebody that can help do due diligence on it and see if there's any problems, bookkeepers. The entity will have its own EIN number, and your fees, right, will be less fees to custodian versus, setup fees. So you need to kind of look at the fees associated with it, because if you're setting up an LLC and you're using an attorney, there will be a fee for that. Now, when I first got into it, I did think I was going to end up with a lot of properties. So I did put a builder there. I did have an attorney. I did have a title company helping me, a CPA, and a bookkeeper. And we went into this, on the auspice of getting even lots and building houses on it, or getting houses or homes and reselling them and rehabbing them. However, I never really ended up getting any of the property. I only got, my interest on the money I put up front, which, was anywhere between 12 and 18% based on how the auctions went. So what are the concerns for an entity with multiple people in it, right? You have more paperwork, right? The partners end up there, right? Decision making, liens versus deeds. Some partners don't want to own the property. They think it has liability with it. So they're happy to get the interest, but don't want the properties. And there's ways around all of these different concerns, because if the entity gets the deeds, they turn around and sell them a lot of times, and that's one of the bylaws in the operating agreement. The fees associated with it, I don't really consider it much either way. Less fees to the custodian versus setup fees. You guys will have to look at that, but I don't think that's a big concern in my book. Other people have raised it, but when you look at it, it's minimal to your returns, right? So what if you get a property, right? Somebody says, hey, I don't want the property. You can sell the property, pay the others for it, or somebody can actually buy the property from the entity itself before it even takes title to it. What if someone needs their money or dies and it's in here? A lot of times they'll make recommendations for that. Some of it is some of the other members will buy their share out of the entity, or they may sell their shares to someone outside the entity already. So none of these concerns are showstoppers, but we want people to be interested and understand what some of those concerns may be going forward if you do pick a multiple entity going that way. As an existing, here's a partnering summary, and I want to show kind of the cash flow that goes into it, and it would be the same for most any other types of entities that are out there, be it a C Corp or a business or a LLC or a trust. It really doesn't matter. In this case, you had Bill's traditional IRA had 50% in the fund. Bill's Roth IRA ends up with 10%. Cheryl has 15%, and Jim personally has 25% in there. So you have a different way of coming up with the money. Totally together, they have $250,000. The tax liens we assumed made about $2,400 a month on the income, and people would pay off, you know, the $2,000 of principal would be redeemed. So you would split the money up, both the principal and the interest from the tax liens and the pro rata share that each of the members had. So if you remember, Bill had 50%. So out of the $2,400 that came in, he would get $1,200 of the interest, which would be half of it. And out of the $2,000 of the principal, he'd get $1,000, and then the others would get the pro rata share going forward on that. $400 in interest income would be the part of that, and the APR on that would be 20%. Who would be paying tax on it? None of the IRAs would be paying tax, but yes, Jim personally would be paying tax on his $100 of interest that year. So what that normally does is it allows people to reinvest more money in the tax liens next year, because they don't have to pay the interest, and they don't have to pay the they don't have to pay the income tax on the interest, so they can reinvest everything that they make. And I usually say some people are making interest on their taxes while other people are paying taxes on their interest, and that's one of the reasons to use the self-directed IRA for this. So I hope that makes that clear. If not, we will have this webinar posted on our website for people to review at a later time. All right, here's another method that people have used for this. Loans, unsecured and secured by liens. So what some people do is they'll actually borrow your money personally or in an IRA, and they'll give you a fixed return. As an example, they might give you a 10 or 12% fixed return on your money. And then what they'll do is they'll invest in these tax liens, giving them, you know, 12, 14, 16, 18, and in some states even 24%. And at that point, what that does for you is it makes your involvement very minimal. And obviously you'll be doing less work, but of course you're going to get a lower rate of return on that. So that's one where people have liked it and they have done that, and there's definitely people out there that will do that for you. And basically for doing that, they'll take the other share of the percentage and basically provide you with the percentage that, or the fixed return that you wanted, or that you signed up for. All right, why invest with a retirement plan, right? So the strategy for building wealth, I think you need to have the tax advantages. I think your most expensive or your biggest expense in life, especially if you're making money, is taxes, right? Your plan can accept contributions, invest in assets, receive income from investments, pay expenses, and actually borrow money. It increases diversification versus traditional stocks and bonds and mutual funds, and payments are not consistent, which is not a factor for many IRAs. So that's one of the reasons I think that tax liens and tax deeds are good for these types of investments. And if you remember earlier, tax liens go in front of mortgages. So you're in front of the bank, and I don't know how much safer an investment can be. In my own mind, that's the way I feel about it. And obviously I'm not afraid to take the property if it's necessary to do that. Hang on, I got a question here. Let me take a look at it and see and do it. So the tax lien is always primary lien position, not the note holder. That is correct. I shouldn't say always. I don't like the word always. Every once in a while, you can end up with an IRS that's in front of the tax lien, but I haven't ever seen that really come to fruition. Most of the time, the townships or the government will step out of the way of a tax lien holder in these cases. Is there a tax advantage for principal reduction? Joseph, I don't know if there's a tax advantage for principal reduction. I don't really know what that comes to, but I don't see it in the, when it's in the IRA for sure, reducing the principal, you don't make any money. To me, you're making less money on the interest, but in tax liens, you either have to pay it all off or none of it, year by year. So I don't see that as a tax saving for principal reduction. All right, so, and the other one is, if you are in the tax liens, and I said that, hey, you don't get this money monthly because people can wait 1, 2, 3 years before they pay you. They might sell the house, they might mortgage the house, they may come into some more money, they may borrow money, etc., to pay off tax liens going forward, and then you'll end up getting paid and you don't have any choice about that, but you'll make all your interest, which I find as being the the worst case scenario since I've done my investing. All right, so hang on, I got another question here. On the page of why invest with retirement, it looks like you are saying your IRA can borrow money beyond margin account. What's to stop the note holder from paying off the liens? Nothing stops the note holder from paying off the liens. In some cases, the banks don't even know. They missed the notices for the auctions, and they will come back and pay off the liens because they don't want to jeopardize their first mortgage position. The other time that they come in and pay off the liens is when you put it up for foreclosure and you're going to foreclose them out of it. They'll come in and pay off the lien at that time and add it to their balance. So yeah, the banks a lot of times will take you out of the position, especially if you force it to sale. I hope that answered your question. I got a yes sir on it. So let's go back down here. All right, so I like this chart because it kind of shows you the difference in holding your money tax-free, tax-deferred, and a taxable account. And this is $50,000 that was put in, and let's just say we put it into tax liens, and I think this was a 10% return, I don't remember. But if you go out to 40 years, you can see that you've got 2.2 million invested in it. And if you're in the tax deferred and you take out I think that's 35% or 40% of that. You end up with 1.5, almost 1.6 million, and you barely, you got 3/4 million if you're paying taxes on it. So that's why I like to use tax deferred and tax-free accounts, because it grows your wealth passively, number one, and secondly, at a higher rate of return, because you're getting to use the government taxes to invest with. So that's one of the reasons I got into the tax liens in my IRA and 401k. Some of the things I try to look at here that a lot of people aren't taught in school, and like I said, I went to an Ivy League college, and one of the things on the economics test was to disregard taxes. And that was really a stupid assumption, because answers would be different if you could disregard taxes. So a lot of people say, oh, in today's environment, if you get a yield of 5%, it's really good. And then in this table here, I took $10,000. You can add a zero to each of these numbers when you add a zero to your initial investment. And I assumed the tax bracket was 30%. But if you're making 5% and you put $10,000 in there in 10 years, because of the taxes, you're going to have $14,000 on your $10,000. In 10 years in your IRA, you're going to have $16,000 because you put it in an IRA. Not a significant difference in my book at that point, but that's with a 5% return. I call 5 or less percent return really lazy money. 10% returns are, is working money. 15% returns are, or better, is hardworking money. So that's, as an example, that same 10,000 in 10 years would double at 10%. And at 15%, it would almost triple in the taxable accounts. In the non-taxable accounts, it would go 2.5 times, or your 10,000 would be worth 25,000, and in 15%, your 10,000 would be worth 40,000. So that's why you can see that I like tax liens that I generally get between 15 and 18%. I just don't bid on anything less than 15%. Now, if you took that out 40 years for some of the youngsters out there, that $10,000 at 5% would be worth 70,000. At 15% return on that money, it's going to be worth 2.7 million in your IRA. So it makes a big difference. And if you do it outside your IRA, then you're only going to have 542,000. So you're going to have 2 million plus more dollars if you do investments in your IRA. And people always talk to me about that and say, how can that be? And the reason being that a lot of these people just don't understand the value of tax deferred and tax-free payments, or they're in a very low income tax bracket. So remember, contributions have limits, because other people get confused and they say, well, how can I get 2 million in my IRA if I'm only putting $5,000 in a year? The answer is those contributions start to have earnings, and those earnings are not considered contributions. So you can still put your contribution in, $5,000, but you can make 18% on $1 million or $2 million, and you'll be making $360,000 that way. So, and any accountant or financial advisor will give you this type of information. So let's go in here. These are the types of self-directed plans, tax deferred or tax free. All of these can invest in tax liens. And again, you can put a lot of them together in an entity. That's another reason people will put an entity in there, because they'll take their own traditional, their Roth, their health savings and educational savings account and put them in one trust or investment club or LLC, and invest in tax liens or other investments. How do you do this? So you'd open up a CAMA account. You'd fund that account with a transfer from another IRA or rollover from a 401k, or you can make a contribution each year. And those are just like opening up bank accounts or IRAs at any other financial institution. And then you'd complete a government bidder application. Like I said, you could go to bidforassets.com or other ones that are out there now. And what you'd fill in is CamaPlan for the benefit of your name, IRA, account number 1234 as the bidder. And you'll need to obtain a tax identification number for your IRA to do this. And then your IRA will be tracked according to that tax identification number if your IRA goes in and buys it specifically. This has become a little bit more of a problem because now they want to have in many of the online, on many of the online sites, they want you to have a bank account associated with that TIN. So we're recommending that you create an entity and a bank account to go along with that IRA when you do this. So Maddie completes the asset purchase, directs it, returns it to CamaPlan with the application. Maddie approves all the documents as read and approved. CamaPlan funds the bidder deposit account per the instructions. We wire funds to it, cashier's check or deliver it to the client. Trust check is mailed to the government entity, or a series of checks are provided to go to the sheriff's sale or the auction or the tax deed sale, etc., whatever it is. Client or the agent bids for the, per the government requirements, either raises the paddle on the courthouse steps or presses the button on the computer. The assets are delivered to CamaPlan's IRA. They're added to the online statement that you can look up at your portal and see what your which tax liens or tax deeds you bought. All expenses for the assets are paid by the IRA. Any excess is returned to the IRA. All proceeds from the tax liens or the tax deeds are paid back into the IRA, and they'll come into us via check or wire if the government entity does it that way, or if they need a specific account, it'll come into your LLC or entity checks that are there. When you go to sell the tax lien and or other people redeem it, you'll complete a CamaPlan deposit form when the last tax lien is redeemed, and then we will close the account and set it up for that. So at this point, you'll have a deposit form that ends up being signed, and the either the deed or the house or the tax lien will be sold, and the asset will be moved from your account and replaced with the cash. So single account versus the entity, right? Both of them have to, in both cases, you have to open an account and then you have to fund the account. And in the one case, the IRA or 401k buys the tax liens or deeds through the online or on-site sales. And then it'll be partial or full sales of tax liens as they come in during the years. And then you can also use this for future year sales in a lot of cases. If you're doing an entity, Once you've opened and funded your account, you can buy shares of that entity. The entity will maintain the books and the values of the shares, or your percentage will be dictating what your payments are that come back, but the entity, the LLC, the partnership, the trust, or the investment club will normally send the shares back at the percentage, the pro rata percentage of your ownership. So tax lien and deed concerns, let's go over this. This is what some people have asked for on some of their questions. One is, what happens in eminent domain? In most cases, when eminent domain is there, they'll pay you what's owed on the tax lien. I've had that happen to me one time, and somehow like I said, I didn't do my due diligence, and I picked up some property running along I-95, and the Department of Transportation came in there and paid off the tax lien, and I got my money. The other thing that's out there is, forcing the sale. How long do you have to wait to get your money? And like I said, that's different in every state, but as an example, 2 years after you buy the tax certificate or tax lien, you can tell the sheriff, hey, I'm ready to pay off, or I'm ready to, I want to collect my money on this. I want to force a sale. I want to take the property and put it on auction. At that point, you may have to pay a little bit extra money, and if you do, especially in Florida, that's good because you'll get a 18% of return on that money, and it'll usually take you, 4 to 8 weeks for the sale to be done. And like we said in the beginning, if nobody bids on the sale, you'll end up with the property. If people bid over the opening bid, obviously you're going to get your money and your interest at that point in time. There are timing issues based on every state. You need to learn them. You need to understand them. Once you have the tax lien or the tax deed in that state, a lot of times you're given first right to buy any other money that's owed on there in the time frame that you own it. In some states you're not, and other people can actually buy in, and then whoever forces it to sale has to pay the others off at the interest rate that they're there. A lot of times you want to check the title work out before you buy these, but as I said in the beginning, I don't have a lot when I'm bidding online, but afterwards, if you're forcing it to sale, you want to understand it. So I normally will get title work, and that doesn't cost very much. And a lot of times the county or the township will pay for it as well. So in some states you can have prior liens. So let's say somebody hasn't been paying their taxes for the last 7 years or 5 years. So you might buy the tax lien this year, but there'll be 5 people in front of you for the last 5 years that bought that. And you'll have to wait 2 years to push that to sale or force it to sale. But somebody that bought it in the first year might force it to sale at the same time that you buy it. And if that happens, you're going to get paid off that year because that guy's going to pay off the year 2, 3, 4, 5, and 6 that bought the tax liens. So there's really no way again to lose unless you let it run out, which in Florida is 7 years, then your lien is expunged. So you have to force it to sale before 7 years. And there's nothing hard about that. A lot of people force it to sale at 2 years and then go out and buy more tax liens. Others, like myself, let it run for 5 years. And then I have less to force to sale and look at. Plus, if I'm getting 18%, I don't mind making 18% for those, year 3, 4, and 5, because it's less work for me, and I'm all about less work and more money. And then once you do get paid back, I basically will turn that money and reinvest it and start buying next year's tax liens with it. So I always try to keep basically a ladder of investments. But as the economy has gotten better, there's less people not paying their taxes, and there's also more people in purchasing tax liens and tax sales. So there's not as much volume out there as there was, and they're driving the interest rates down because we're in a yield-starved economy. I mean, think about what you get for a CD in the bank, is a half, 1, maybe 2% on money markets accounts in a lot of places, compared to an 18% secured by real estate first position note. So that's mainly my thought process, and the concerns associated with the tax lien and tax deed world. And I'm not afraid if it turns into a tax deed that I get the property, either sell it as it is or fix it up and make a bigger profit. Typical fees, I said we'd talk about the fees on here. CamaPlan does this where we basically say it's $275 a year if you have over 40,000 invested, and I think that's usually the best deal. If you have less than 40,000 invested, a lot of times option B is there, but most of the time you're going to be paying $150 to $275 a year for the tax lien investment. And that's whether you do it individually or if you get into an entity. There is some miscellaneous processing fees like wires and overnights, and that's all on our fee sheet too, and those are typical to the bank fees. And I always tell people, the fees are insignificant to the savings in most cases, and if they're not, then I would say don't do that. And that's up to you to decide, and it's up to each individual to know his tax rate, how much he's buying, how much he's putting in there, and what his returns are. So to me, it's a little bit boring on the fees, but call our office if you want to, if I haven't explained it right, and talk to one of our account executives. Here's an example of what we've done. Brevard County tax liens, 15,000, so you're going to be paying $150, or you could do the asset based if you thought it was going up, which would be $275. So based on the two ways of we doing the fees, this is just kind of an example of where we are. If you're doing 90K and you have 3 assets, then it's going to be $825. If you only have 1 asset, then it's going to be $495 on the value-based side. If you only have 1 asset tax liens, then it would be $275. If you do the investment club and you have $1 million into it, you can either pay $1,850 as the max, or you can do 1 asset at $275 for $1 million. So in that case, obviously, it's very minimal fees for that. And here we have tax liens in Brevard County, Florida, Mercer County, New Jersey, and Radnor, I think, was Pennsylvania, but they don't have tax liens there. They have tax deeds. So this kind of goes over our fee structure. So let's talk about a $15,000 tax lien account and go over how much you think you would make in it. So if you open up the account, it's $50. Purchase tax liens is $150. Cashier's check $40. Annual fees $150. So you got total fees of $390. You're going to be paying $150 per year that you're there. 4th year, you're going to have some partial sales, and the 5th, you're going to be paying 185, so you got a total of 1193. But your interest earned in these cases is, 2,700 per year, or 13,500, and your annual account value is going up compared to the chart below, which shows how much you net out of it at that point in time. So you make about 50% more, even with a $15,000 net worth increase at that point in time, depending on your rates of return. I don't want to get into too much of the numbers, but these charts go over the same thing with 100,000 in them, and you can see kind of the differences between not paying taxes and paying taxes. And then there's one here with $250,000, and your rate of return is about 22% higher than if you do it in a taxable bracket. All right, so at this point, I know we gave information on the tax liens and the tax deeds. I'm going to open it up to the questions and go back and read some of them here. But this is the information from the IRS that talks about IRAs buying assets, as we discussed here today: the tax liens, real estate, notes, mortgages, private placements, etc. And most of the information on today's webinar was taken from these publications. Disqualified persons, you can't buy tax liens from these people, and if you are doing IRAs or LLCs with other individuals, some are okay and some are not, and you have to be very careful and get your legal people involved with that. But you're disqualified, your parents and grandparents are, and partners, etc. But aunts and uncles, cousins, nieces and brothers, the ones in green, are not disqualified persons for going forward on this. So what does your advisor think of what I just told you about today and self-direction? A lot of them are going to wonder if it's really legal. They're going to say that it's risky. I already talked about risk. Your money's in a FDIC insured account if it's not invested. If it's invested in tax liens, you have to assess that risk. My personal feeling is tax liens secured by real estate, in front of a mortgage, is not risky, but is not as risky as other investments. So I like them, but if you find an investment that isn't risky, let me know. I'll be glad to help you invest in it if it's got a decent return. A CD is, that lazy money I'm not interested in. Is the process complex? Some of those people think it is. However, we're here to help you with it, and you'll have to make that decision. But call our office. We have thousands of people that are doing it, and they like it and enjoy it and think that it's well worth the complexity if it's there. And we do try to make it easy for you. If you want a calculator or an article about converting to a Roth, and I say that because I'm very pro Roth, call our office. Is this any better? Hello. Test. All right, sorry for that, everybody. I guess we lost the audio on this, and we will, I don't know where we lost it, but I will redo this webinar based on where we lost it and repost it. I'm sorry for that inconvenience. Have a good day, and we will write info at CamaPlan, and I'll send you at info@camaplan.com, and we'll send you copies of this presentation. Thank you.